Again, thanks for having me here today, and really excited to be here. So let's get started. So what I'm going to talk about are two really amazing option strategies that provide very low, high reward type of trade setups. And they're great for any kind of market environment, but especially when you get in even more high volatility markets. So you'll see why as I go through the presentation here today. So let's get started. So the following presentation is purely for educational purposes. Any stocks, options, futures, or ETFs mentioned does not constitute advice and should not be construed as a recommendation. Now, the secret for me for trading profits really comes down to three things: direction, timing, and then option trading management, which I call a lot of times opportunistic risk management, because by using options, we have such great flexibility and so many different options as to what we can do as far as trade adjustments, defense, things like that. So the two strategies I'll show you here today are great for just directional trades or for using for hedging. And so again, they're very amazing because the flexibility they can offer your trading. Now, when you're trading options, they have so many more advantages than just trading outright stocks. But yes, you probably know they can be a bit more complicated as well. But once you understand the benefits to the advantages of options and option spreads, you're really never going to look back and want to do anything else but use these types of strategies. And when you're using option spreads correctly, it's going to provide you really defined trading risk on all of your trades taken, will lower the capital that you're putting up at risk, will offer you greater trading leverage because of the options and the way that they work, and they're unmatched as far as hedging, so a hedging advantage. Now, we've been on a tear to the upside, and one thing I always tell my clients and members is that you better understand how to hedge, because you need to be able to set and affect hedges real quickly, and these are two strategies that allow you to do that. Now, I've been trading options for over 30 years, and I've found that the most valuable go-to option strategies that can help literally any trader out there more than any other is understanding how to use these two option strategies, especially when we're in extreme market uncertainty, and you'll see why. And these two strategies are the butterfly and the long condor, so they're kind of what I call my trading secret weapon. Now, the huge advantage that these strategies will give you is based on their unique option framework that's designed to take advantage of time decay and volatility, the two main option pricing components. And this will help to kind of stack the trading odds in your favor, and can be used in any type of market environment, which makes them a perfect trading strategy or vehicle for especially when you get into uncertain market extremes or extreme volatility. So if you just know when and how to use them, they're going to be your favorite kind of go-to strategy. Now, because they're structured to require only a small amount of your hard-earned capital, your trading returns can be very explosive, and I kind of call this kind of lightning in a bottle. I had a boss that I first worked for when I started trading on the oil side years ago, and he would get a trade that was so fantastic. He'd say, "Ooh, this is like lightning in a bottle." And a lot of times these are explosive trades. You can kind of qualify and say it's kind of like lightning in a bottle, and you'll see some examples here. Now, when we look at the butterflies and long condors, they're very dynamic, and they can be traded for a variety of different reasons with different goals in mind. So in other words, once you learn how to use the butterfly and condor, long condor, you're going to be covered for your offense and your defense. So both your goals and protection, or profits and hedging. Now, the butterfly and long condors, they can be used for hedging. And so that's really one of the big benefits. And so if you don't get anything else out of this presentation, try to think about the hedging potential that you're going to see here today. So when you mess something up, and it's going to happen in trading, you need to be able to take a fast, low-cost way to cover your pronto when a position starts to move against you. And literally found no other hedging strategy that comes close to incorporating these two type strategies into your trading plan. So for example, if you construct either a butterfly or say a long condor around a strike that's under pressure from another core trade setup, such as let's say you do credit spreads or debit spreads and they start to go against you, this becomes a really great way to immediately neutralize, and not only neutralize the risk, but lower the risk. And that's a big, huge plus for your trading account. So this is a good example from one of my members, Pam. She said, "I wish I'd known how to do this hedging defense before I lost so much money doing credit spreads." So how many people here have done credit spreads? If you have, put in a number one, but you'll know what we're talking about here when you do a credit spread. They look great, they're probability trades, but all of a sudden you have one go through your short strike and boom, you've had a big loser. But we can use the butterfly Condor to immediately hedge and help you through that kind of situation. So what it does is it helps you keep your original position open by just implementing either a butterfly or long Condor hedge around your original position. So what this does, this strategy takes advantage of that time decay component of option pricing. And so while you're waiting, and many times that's all you need is just that little bit more time for the trade to work out, stabilize, and moving it back in your favor. But while you're waiting, you're getting the time decay component from the sell side of these option spreads. Now, that a lot of times can help you actually even lower your cost. And though, once the market stabilizes, you probably improve your position from the time decay, and then you take it off and let it run. So it gives you a huge amount of flexibility with this hedging. So basically, here's kind of what you're looking at. So here's a real kind of simple example, but this is exactly what you can do. So let's say you're long a call debit spread or something like that. So you're long a call here. Okay, and you've got going into the trade, you've got $300 of risk, which is nice. Debit spreads are, defined risk trade. But what I try to always do is never lose your total at risk. So we can easily neutralize and actually lower this risk from $300 by selling a credit spread against it and converting it either into a Condor or a butterfly. So in this example, I'll show you what we could do to lower that risk if we sold a credit spread. So I could sell, with the same short strike as the debit spread and bring in, say, $200 credit. And now I've created a simple but balanced butterfly, and I've reduced the risk on that debit spread from 300. And now my total risk has gone down to $100, but I still have potential for a big, huge profit if the trade stays within what we call this profit zone or profit tent, or I could leg out of either side, or I could add additional layers to this as far as additional credit spreads and make ratio butterflies, things like that. So it gives us a huge amount of flexibility in our trading, and it's so fast and quick that we can immediately, kind of do this kind of risk adjustments fast. And that's key too. When you have a fast market moving, you want to reduce that risk, and then you have time to sit back and think, okay, what's my next step? So it buys you time, and psychologically, it really helps your trading. So we could either do it to the butterfly, or we could do it to what we call the long Condor, which is very similar, but what it does is it spreads out the credit spread side more, so you have a bigger profit zone. So instead of selling the same short strike here with the butterfly, we can push this out to make a bigger zone for profit. But it does the same thing as a butterfly. Number one, it will reduce our risk, but it also, these two strategies also then give you positive theta, so you don't have negative theta on any of your trades, which is another, big disadvantage sometimes if you're just long options. So those are the two great benefits there from a hedging standpoint. Now, the core concept that makes, the butterfly and long Condor work, let's go through that. And it comes down to, those option pricing components. So when we look at options in general, the most important option factor for, profit generation, especially when we're using something like a butterfly or Condor, long Condor, comes down to understanding how option pricing works and the big concept of time decay, which is the big, huge, pricing component of your options. So let's take a kind of a short review of that. Now, when we look at what we call theta or option theta, theta is what the Greek that tells us how much an option price will go down over time. So it's the rate of the time decay of your stock option. And time decay occurs because the extrinsic value or that time decay is going to go down each and every day. It's a decaying kind of component of your option price, and it'll go to zero at expiration. So when we're selling or doing a butterfly or Condor, we're actually getting that sell side component of time decay in our favor through the positive theta that it generates. So let's take a look at kind of a quick example here of a butterfly to show you how that can really lower your risk. So here's like XYZ, the famous company. It's trading at $45. And we're looking for it just to go down here to 43. So I'll always have a target before any trade ever put on. So in this example, we're just looking for, like a $2 move down, but to 43. So we can use a butterfly. And typically what we'll do is we'll target your target will be the body of your butterfly. So in this example, for downside move, you want to use puts. So we could come out, we could buy the 44 put, and we pay $2.38, which would be like for one option contract, $238. And then what we do is we would sell a July 43 put under it, bring in $1.67, $167 credit, and then we'd sell it again and then buy below that the 42 put. So we're capping our risk. So we have no exposure as far as we're not naked short, a put or a call or anything like that. So what we've done here is we've created a kind of a narrow wing butterfly. So our costs, if we go through the total risk, go through the cost components. So we paid $238 for the 44 put, $1.06 for the 42. Then we receive back $1.67 twice, convert it to an option contract. So the total risk in this example would be $10 per option spread or per butterfly spread. Now your profit is your difference between your strikes. Okay, so you can see it's $1 wide on the different strikes. So you take that less your cost of the trade here, 10 cents or $10 times 100. And so now your total potential profit on this is going to be, you take 43 minus 42 minus the cost of the trade, 90 cents times 100. So theoretically, if this went out at expiration, right at that butterfly, the top of the tent, your profit zone, you make $90 on your risk of 10, that's a 900% return. So you're risking $1 to make 9. So of all the different option spreads, this will give you the highest return of any option spread that's out there. So you have tremendous potential upside. So you can make, even better than 9 to 1. You can make 10, 11, 12 to 1 sometimes. But that's basically how it works. And so we can do this using calls or puts, and then we can structure it for different widths of the spread and add ratio, different other type of variations. But that's the general concept. Now, the next thing then comes to, what is the best butterfly or long condor strategy to use? And then that comes down to kind of your trading goals and, how much time you have to trade, et cetera. But, when you're looking at trading, especially these types of strategies, you should look at your goals as a trader. So in my opinion, one of the major goals for every trader out there really should be to select trades based on, what's going to give you the most consistent positive returns over time, and that are low in defined risk and not always the greatest return. So I kind of compare trading in the long term or long run as to, hitting singles and doubles. That's your objective. And then occasionally you're going to hit the big home run. So that's kind of the thing to look at. So I always look at the risk first and then look at the reward based on that risk and look to singles, doubles, and then we're going to hit some bigger ones along the way. And then it keeps you having a better, positive equity curve with a lot of less aggravation. And then one of the best ways to do this is to know what are the different option strategies that are available to you, understand how they work and when to use them, and then select the one that's going to be best suited for you and your trading goals and the market environment you're trading. So, everybody here today will have a different amount of capital that you can trade, and you might not be able to trade full time, staring at your screen all day. So that's going to make a big difference. But these two option strategies are two that can be used for any size trading account, and they can be used, as more of a passive way, so you don't have to be glued to your screen. But you can use it with a small trading account of $2,000 or $3,000 up to big hedge funds of millions. And I've done butterflies on oil, butterflies, thousands of contracts and things like that, or down to one contract as a retail side of things. So they're very, very flexible and available for anybody to use. Now, when we look at the butterfly, I kind of call it the butterfly family because there's a number of variations of the butterfly. And they're basically all one of the common denominator between these is that they're all going to be a strategy where you're actually taking advantage of selling time and volatility as well. So we've got a kind of the variation. We could do a call or put butterfly. We could do what we call a broken wing call or put butterfly, which sometimes referred to as skip strike butterfly. We could do what I call the ninja or unbalanced ratio butterfly, iron butterfly, and then there's a whole category for hedging using the butterflies. And then the other category, kind of the cousin to it, as I call it, is the long condor option spread. So we're going to go through some examples here to get you an idea of how they can work and give you a benefit to your trading. So first off, let's take a look at some butterflies. Now, the other thing to understand is when we're looking at a butterfly, we can adjust actually the risk and the profit with a butterfly by the wingspan of that butterfly. So if I back up here and kind of explain this to you, when I say wingspan, we can make these butterflies a very narrow depending on the spread width, or we can make them very wide to give us a bigger profit zone. So if you're thinking about going out and you're trying to capture a big butterfly or butterflies in general, you're going to have a bigger success or better success, put it that way, if you had a big wide butterfly, right, net, because it's going to be a bigger space versus a small net. All right, so the same kind of concept here. So we can really broaden out a butterfly, make it really super wide to give us a big profit zone. But if we're going to want to really control our risk and reduce it, we can narrow that butterfly and make it very, very low cost. And a lot of times this is what we refer to as maybe a lotto trade, because we can make these as low as $10 per contract risk, but you have potential to make maybe $90, which would be a 900% return on your risk of 10, or sometimes even bigger. So it gives you a lot of different ways to approach the market. So let's take a look at a few trade setups here. So the first one will be like a narrow wing butterfly, so very narrow wing, low cost. And here's an example. This was on SPY. The ETFs are fantastic, SPY, QQQ, IWM. The index options are great, SPX, RUT, those types. Now with this, I always use Fibonacci to help kind of with targets. So here we had a price high here and a price low. So I had my fib levels in here and was targeting the 618 retracement area coming in at 273, 274 right there. So this was what I call a target trade. There was also a lot of option activity here, so I gave a really good target, but wanted to keep the risk super low. So here's the trade setup. So with this one, we used the target. We are targeting right here 273, 274. Okay, so what we're going to do is use the body of the butterfly as the target. So we if you kind of follow this, we'd be looking here to the target 273. So we're going to buy a 272 call, sell the 273. If you look at that, that's a call debit spread, then sell at 273.74. So we just created this really narrow butterfly, dollar wide strikes. Okay, so dollar wide would be $100 per option spread less the cost. Look at how low the cost was, 10-cent debit cost per butterfly. That's the max risk if you made everything wrong and it went straight down or straight up. Now, if it goes straight up, there is the part of assignment risk, but that's if you understand what extrinsic value is and how to look at it, it's very, 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 very small, and it should never ever happen to you. And I can explain more in detail if we have time. But here in general, the total risk is $10. But then theoretically, you would make $90 if it went out exactly at 273 at expiration. Now you'll never get the max, but you'll get close with the butterfly, because that it's kind of like a thread in a needle. But still, look at the potential reward. So here theoretically, you could make maybe 900% return on that risk. This example made in 2 days $70 per spread on the risk of 10. That's a 700% return. So somebody might tell you, hey, I just made 1,000% return, and you might think that they're lying, but then they say, well, I did a butterfly and this is how it worked. And if you understand it, you'll understand the concept that it does happen. So here's the example of where it was going out. So you can see this purple line is what we call the T+1. That's where it's price at time. The price at time is right there. So this was going out at expiration on that Friday expiration. It was going out pretty close to that target of 273, not exactly, but close enough. So this was up on per contract. It went, you can see where my pointer went from 10 cents debit to 80 cents. So that's $10 to 80. And so that would be your profit. The difference is $70 per spread. And this example had 4 contracts. So that's $280 on that low risk of $10. So it's a fantastic way to, really keep your risk low, and think about if you're in a really extreme market environment where, headlines can sabotage your trade day in, day out. You want to keep your risk low, right? And so this is the perfect way to do it in a lot of situations. Now, this is another one where we're going to widen out the butterfly to make a bigger profit zone or a bigger net. So we're going to widen, instead of having a really narrow one. And this is one, I've got a trade alert service, and these are alert trades, but this is one we just did about a week ago to show you the example. So this was on Spotify. So we were looking at a directional trade to the upside. So we wanted to do a bigger, wider butterfly to get a bigger zone to participate. Just if we get in that zone, we can still make profit, but have it on very low risk. So let's go through this example on Spotify, and I'll show you how this works. All right, so why the wider wing butterfly? So These can be structured, again, for defined risk and hedging, fantastic for hedging, used for what I call kind of targeted directional swing trades. I like to do swing trade type of setups where, you know, they could be 1 day to 2 weeks. Great for what we call pinning trades, kind of a directional trade where we think a strike may go out. Fantastic for high volatility markets because we can keep our risk super low. Great for trading really high price stocks, right? Because I'll show you an example on Amazon where, you know, it's hard for, you know, a smaller trader like ourselves to trade the big stocks like maybe an Amazon or Tesla or even the spot that I'll show you. Trade durations are 1 day to 2 weeks and no time decay, positive theta. Returns can be 2 times to 10 times or higher on your risk. So here's the example. This is one we set up in, just 2 weeks back, I guess June 23rd. We had an entry right here based on my trading model. So we had a trigger entry, we call it trigger entry right here. So we got in at 257. But we wanted to do this. Spotify had been, you know, hit really hard, and there was a lot of moving average resistance over here. You can see this is at like 100 period and 200 period moving average. So we wanted to keep the trade very defined risk in case, you know, it got rejected at these moving averages and went straight back down. So it was trading at 257. So we set up a butterfly, and I'll show you how that worked out. So what we did here, we used our body was the 270. That was our target, was going to be to 270. All right, so let me back up so you can see the target here. If I can pull this back real quick here, I'll show you the target. So we were targeting right in here. See this fib level, 618, 265, and that was a 100 period moving average, so kind of around 270. That's our target. So what we did here is we bought the 260, 270, and sold the 270, 280. So $10 wide spread, butterfly spread per contract. Now, going into this, we had a total risk. This costs us $1.50 or $150 per butterfly spread. That would be your maximum loss if this thing cratered and went straight down, you did no adjustment. But we always do adjustments, so we'll probably, you know, never ever lose the full amount of some kind of debit like that. Now, when you do one for 10 bucks, you're doing it to say, okay, you know, I would risk 10 bucks would be my risk. But in this one, we risk 150 bucks and we could adjust it. We could do a lot of different things, but it went perfect for us. And you can see here, this was on, we had profit take on the 29th, 30th, the 1st of July and 2nd. So on the July 1st, this was last Thursday, it had traded up to close into our target of, it was trading at 268.44 here. So we had a profit take here of $425 per spread. So you can see it went from $1.50 to $5.75. So 150 bucks was our cost and it went to 575. So started to scale out, you know, take profit. So 425 bucks per spread on that. That's a 283% return on that risk of 150. Look at the positive data. So every day we were making $57. Now, then the next day, this thing pops up even more. So it's at the same price, actually a little bit lower, but it's sucking out that theta and that's going straight to our pocket. So look here. So the day before it was trading at 268.44. We were up 425 per spread, 283%. 1 day later, it was still at that same price, but we were up another $100 per spread, or 370% return because of the positive theta that we were sucking out. Now it's 96. All right, so this went, now it was from 150 to 705. So we're up $555, 370% return. So time decay going in our favor with that positive, big, huge fat theta. Volatility going to our pocket because of the volatility was being stripped out down to zero, and what we call collapse and a high return on capital. So theoretically, this could have made, if it went out exactly at 270 at expiration last second of the day on Friday, 850 bucks on 150, that's 566, but, you know, perfectly happy with, you know, 555 or 400, whatever, you know, still a fantastic way to trade. So here's another example, another one. Now this one I want to show you because, you know, Amazon is currently now, I mean, this was back when Amazon was trading at 1782. And now, you know, Amazon's trading at 3,675. But here's how you can trade these really high price stocks like an Amazon. So we were targeting a move up here to 1830. And, you know, we wanted to do a trade. But so if you're, you know, a small trader and you picked up 100 shares back when this was 1,782, that would have cost you $178,200 for 100 shares to make it equivalent to this, you know, option. But instead of doing that, and if it did go to 1830, you make $48 a share, so 2.69% return. not too great, right? And a huge amount of risk. But with this trade, we controlled 100 shares, basically worth over 178,000. We did it for $80 per spread by doing a butterfly. And so again, did a $10 wide spread butterfly targeting 1830. So $10, 1820, 1830, 1840, $80 per contract. Boom, that's the max risk there. If it did go to the 1830 at expiration, we would make 920, and that's over 1,000% return versus here at 2.69. So it just doesn't even compare. But that's one benefit. But here's the other really cool thing about this strategy, because we've sold volatility in time, and at the last day we're stripping it out. So here is going out at expiration on the 6th, and this is in the morning AM, and it's trading pretty close to our target. It's trading right here at 1836. It had actually gone over, all right, but trading right here in the morning, this was up $150 per spread. So it had gone from 80 cents or $80 to 230. So we had a nice profit, $150 in the morning, 187% return. But holding this into the afternoon and still trading kind of like that spot trade, now this thing is up 4 times more in the same day. So now you can see the trade went from 80 cents in the afternoon. Now it's trading at 695 or 695. So it's up 4 times more, and we had a return of 769%. That's because of that, again, the theta. See the positive theta here, 33. And this was in the morning, it had 80. And then in the afternoon, we sucked out, a big chunk of that. And that's how it works. It's a beautiful trade setup like that. Now, the other one I'll show you is the long Condor, very similar to the butterfly, but we can make our profit zone wider. And this is one of my favorites too, because we get that profit zone wider. This is usually the first go-to setup for a hedge. And so here's, again, it's great for hedging because this is an example of a SPY put debit spread that we adjusted to a Condor, and we were able to turn this into actually a free trade by doing this hedge. All right, so this was a put debit spread, and it was trading at the time right about here, 275. And again, using Fibonacci, we were targeting down to about 270, this area here. So we set up a put debit spread to start with, and then so we had the 273, 270 put debit spread, okay, $3 wide, really nice low risk trade itself, $65 max risk. But the problem with the shorting, as you probably know, is that you short something and it doesn't stay down. It might go down for one day or for the morning, and then it's back up in your face in the afternoon. So with this one, what we did was, instead of if you held it, if you could have held it, it went through and closed below your spread, your 270, you make $235, 360% return, pretty good. But what we did, once it went down, we targeted trying to see if we could convert it to a free trade. So it collapsed down. It was trading about 271. So we took partial profit of $98 per spread on that risk of 65. That's 150% return, not bad. But then instead of doing the whole trade there or holding on to it, we were able to adjust it by selling a bull put credit spread to bring in an additional premium when it was trading down here to that 270 area when it crashed down. So we sold the 268 put short, bought the 265, a bull put credit spread, brought in $65 credit. And what does that do? That offsets the debit costs. So the original trade had 273, 270 put debit spread, $65. We sold it when it collapsed down, the 268 to 65 brought in 65 credit. So now we have zero risk in this trade. Now, if it was to go out between these two spreads, the short strikes, this would make $300 on zero risk. But now you can just kind of kick back. You don't have to worry about it. And this ended up going out right here. So we took it off with $164 profit. So it's traded at 170, 133. So 164 on zero risk, take that all day long, right? So that's the Condor, put Condor. We do this with calls or puts, and it's just a great way to hedge. And it's kind of the initial hedge that I'll usually look to put on. So if you compare the two, trade one made 98, not bad, 150% return. That's great, I'll take that. But trade two, we had zero risk, so zero stress for the balance of the trade. It made 164. So just a lot of things you can do, just provides you so much flexibility. And if you'd like to learn, more how to master these, high reward, low risk trades that work in any environment, here's a great package for you today if you'd like to take advantage of it. So what you're going to get is my Butterfly Long Condor Masters course that I did a few months back. So it's a 7+ hour trading course just on these 2 option strategies. And it's going to be broken down in kind of modules like a chapter of a book. So use this link here, and let me make sure it works, and it's yours forever, all the course and the bonuses for the price of just $97. If I can find it, I'll show you. So just use that link and just click on it, and you can use credit card or PayPal. Now, what you're going to get, not only will you get this 7+ hour recorded course, broken in 30-minute modules or less. So I do the courses in modules, so it's kind of like a chapter of book. So module 1, I'll show you in a minute. And then it's a 465-page PowerPoint training manual. My courses are very, very detailed with trade examples. Plus, you're going to get 6 bonuses. So for $97, this is all yours. And then you're going to get the full recorded course and the PowerPoint of the course in modules. So this will be on the clouds. You can access it from any place. And then you're going to get my new options for beginners course. This is a really good beginners option course for you if you kind of just starting out. Here's a great package way for you to get into the option side of things with very little cost to you, and you should be able to probably make this back pretty fast if you get into it and learn these strategies. But it's going to be all laid out for you. So you get the option beginners course, and then I'm going to give you, for your additional support, I'll give you a trial membership, a 30-day trial membership to our trading club. Power Cycle Trading Club, and that's going to be then $97 a month if you want to continue. But this will give you a 30-day trial membership, which gives you, I have a virtual trading room, so if you have any questions on the course or trades that you need help with, you can come in and ask questions or see what trade setups we're doing. So you'll get that as a kind of support value to you. And then we'll even do a live follow-up Q&A for you. I'll send you an email to tell you when that'll be, usually probably a week from now or 2 weeks. So you'll get that as additional support value. You're going to get my option trading tutorials, another option course basically with basically on the Greeks and probabilities. So another option great course there, and my option strategy manifesto guide. So a lot of great option educational material here for you, and it's just $97. And then my Greek power tool guide. So this is the Greeks that you can print out, put on your desktop. So really good bonus package there for you. Now you'll get the butterfly course, again, 7+ hours, broken in modules, 465-page training manual of the entire course. So it's kind of what I call my blueprint course to show you how this works for income, directional trades, non-directional hedging, things like that. So part 1 of the course will take you through the option Greeks that are important as far as the how they affect the butterfly, time value, time decay, volatility. So you're going to learn a lot just for your option trading in general. So very detailed course to take you through what makes these things work, how option pricing works, how what we call Fibonacci target mapping to set your price targets that you need to use. So target mapping using standard deviation of Fibonacci, that's covered in the course. And then part 2 is what really makes these kind of trades work. So it goes through every variation of a butterfly and how, why, and when to use with trade examples of how, why, and when would you use a call butterfly or put butterfly, the wide wing butterfly, broken wing butterfly, ratio butterfly, broken wing ratio butterfly, iron butterfly, vacation butterfly, and long condor. So like bubblegum shrimp, but you'll have it all here, everything about a butterfly. What are the best time frames to use to capitalize on using a butterfly, and what should you use it on with stocks, ETFs, index options, or even futures? How do you get those 10 to 1 or higher returns, ratio returns? What is volatility collapse and time decay? How can you take advantage of that with the butterfly? And then a whole section or a chapter here is on what we call option expiration or pinning trades, which are every monthly option. What we do is we try to pick based on option target pricing where a specific stock or ETF may go out and pin. That means where it will go out at expiration, and then we can set up a butterfly around that. So it teaches you how to do that. And then a section in the course to just strictly on the long condor, one of my favorites, how to use the option long condor, which is not the iron condor. This is a different animal to give you returns of 100, 200, 300%. So it's a low capital at risk positive theta trade setup as well. So how, why, and when to use the long option condor. And then a whole chapter here, not even a chapter, but part 3, the biggest part of the course, is on hedging. So I tell my members, if you don't know how to hedge, your trading accident waiting to happen. So this will take you through what I call the progression of hedging. So if you just had a long 100 shares or something, how can you hedge that? Then how can you hedge that on top of it, et cetera? And then how to use the butterfly and the long condor to hedge your core position. How to use a butterfly or long condor to defend a vertical credit spread or debit spread. So if you've been doing debit spreads and getting whipped around, or credit spreads and getting run over, this will teach you how to defend it quickly. And then a step-by-step checklist of when to put them on, take it off, execution, trade management, and then a resource area or page or chapter on what is exchange traded funds to use, what is assignment risk, expiration risk, how that works, and how not to be terrified about it. And then a trading library to show you past trades. So it's a great course in general. So I'm about running out of time, but your bonuses here, and here's the link again, will be a great bonus package. I want to try to get everybody into the option scene here. So this is kind of a bonus option package. So you get my option beginners course, so on-demand recorded course, comprehensive course on the benefits of options versus stocks, puts versus calls, how option expiration works, take you through 2 really good strategies, kind of a beginner's covered call and then a covered call with protected put, a collar strategy. So you get that. And then you get a trial membership to my trading club. So 30-day trial membership. I have a virtual trading room open each and every day in the morning. So you get that. Plus my Q&As every Tuesday. We did today over an hour today, which is live and recorded. And then you get 60% discounts on all course software that I have and course anything on my website. So you get all that. And then, so virtual trading room every day open. Do a video newsletter every day after the close, which is sent out to all of our members. You get that. Live Q&As every Tuesday. Traders Educational Vault, a lot of good educational material for all the members free there. And then you'll get 6% discounts on anything on my website courses. I have a lot of trading software that I've put together. So just a really good benefits there. And then we'll do a follow-up Q&A. Plus, I want to give you more support, so that's why I give you the 30-day trial membership. Now, if you stay, and you can start this when you want. You don't have to start this today if you buy the course. If you want to go through the course, start it a week or a month from now, just let us know and you can start your time then. So you'll get that for additional support. Then my option trading tutorial, 60-page option guide and videos about the Greeks, what we call the market maker secret, standard deviation, option delta probabilities, and then 15 other option strategy guides. So this is another guide to show you how to trade construct and when to use, such as like a back ratio spread or a long straddle or strangle. So additional option material. And then my option brief, option Greeks power tool guide. So this will be the Greeks and you can print it out, put it on your desktop. So just a fantastic kind of overall option kind of a, bonanza, I guess I could say, package for you. So for any advanced trader or beginner trader, this will get you rolling. So hopefully this has opened your eyes to some other ways to trade, and hopefully I'll get to work with you guys and gals here in the future. So I've got a few minutes here, two minutes or so. If there are any specific questions, please let me know. And that link there, use that and you'll get that full, course bonuses in the butterfly course there. So I think that pretty much wraps it up. Any specific questions here? I'd be happy to answer. All right. Well, I appreciate your time today and look forward to hopefully working with a few of you guys and gals here in the future. So good luck trading. And again, thanks for having me here today, Dave, and appreciate it. And everybody, all the best.